You've probably heard people say, that stock is overvalued, or this company has strong fundamentals. But what do these things actually mean? In this video, I'm going to show you exactly how to read a stock like a pro using just 7 simple terms. By the end, you'll know if a stock is cheap, expensive, or actually worth buying. No complicated stuff. Let's dive in. Hey, don't go. Term 1, PE ratio, price to earnings ratio. Imagine 2 stores sell the exact same product. One charges $10, the other charges $50. You'd immediately ask, why is one so much more expensive? That's exactly what the PE ratio does for stocks. What it means. The PE ratio tells you how much money investors are willing to pay for every $1 of profit the company makes. A high PE means investors are paying a lot because they expect the company to grow very fast in the future. A low PE could mean the stock is a good deal, or it could mean the company is in trouble. You have to check. Formula: PE ratio equals stock price divided by earnings per share, EPS. Example: Apple has had a PE between 60 and 80 for many years. That means investors pay $60 to $80 for every $1 of profit because they believe Amazon will keep growing a lot. Coca-Cola usually has a PE around 25. It's a steady, mature company. Neither is right or wrong, they're just different types of companies. Buddy, if a company is losing money and has zero profit, the PE ratio doesn't exist. That's why new startups can't use this. Term 2, EPS, earnings per share. Apple made over $100 billion in profit last year. That sounds huge, but what does that actually mean for you if you own just a few shares? EPS answers that question. What it means. EPS is the company's total profit divided by the total number of shares. It tells you how much profit did the company make for each single share you own. If EPS keeps growing every year, the company is becoming more profitable, and that usually pushes the stock price higher over time. Formula: EPS equals net profit divided by total shares outstanding. Example: if Apple makes $100 billion profit and has 15 billion shares, the EPS is about $6.67 per share. Every quarter, when Apple announces its EPS, if it's better than expected, stock price usually goes up. If it's worse, stock price usually drops. That's why earnings season is so exciting on Wall Street. Bonus: EPS and PE work together. You need EPS to calculate PE. Term 3, P by B ratio, price to book ratio. Imagine a house is actually worth $200,000, but the seller wants $400,000. You'd say it's overpriced, right? The P by B ratio does the same check for companies. What it means. P by B compares the stock price to the company's book value, which is basically its net worth, all assets minus all debts. If P by B is below 1, the stock is trading for less than what the company is worth on paper. Possible bargain. If P by B is above 1, investors are paying extra because they believe in the company's future. Formula: P by B equals stock price divided by book value per share. Example: Warren Buffett used P by B a lot early in his career to find cheap companies. Banks like JP Morgan usually trade between 1 and 2 times book value, but Microsoft trades at 10 to 15 times book value. Why? Because Microsoft's real value is in software, brand, and ideas, things that don't show up as assets on the balance sheet the usual way. Key point: P by B works best for companies with lots of physical assets, like banks or factories. For tech companies, PE is usually better. Term 4, ROE, return on equity. If you give a manager $100 to run a business and he returns $20 profit in 1 year, that's a 20% return on equity. ROE tells you which company is better at using your money. What it means. ROE measures how efficiently a company uses the shareholders' money to make profit. A high ROE, 15 to 25% or more, means the management is really good at growing your investment. Warren Buffett loves this metric. Formula: ROE equals net income divided by shareholders' equity times 100. Example: Apple often has an ROE over 100%. That's because they buy back a lot of their own shares, which makes the math look amazing. NVIDIA's ROE has been extremely high in recent years thanks to the AI boom. If a company can keep 20% ROE for many years, it usually has a strong competitive advantage, a moat. Warning: very high ROE can sometimes come from too much borrowing. Always check the debt-to-equity ratio too. Term 5. CAGR, Compound Annual Growth Rate. Your money grew from $1,000 to $3,200 in 6 years. Sounds good, but is it actually impressive? CAGR gives you one clear number to judge it properly. What it means: CAGR is the average yearly growth rate of an investment over time, assuming profits are reinvested. It smooths out the ups and downs so you can compare fairly. You'll see CAGR used for stock returns, company growth, mutual funds, and your own portfolio. Formula: CAGR equals ending value divided by starting value to the power of 1 divided by years minus 1. Example: the S&P 500 has given about 10% CAGR over the last 50 years. $10,000 invested in 1974 would be worth over $1 million today just by holding the index. NVIDIA's revenue grew at over 40% CAGR in recent years. That's why its stock price went crazy. Tip: when someone says, "We made 80% in 3 years," ask for the CAGR. It's actually only about 21% per year. Very different picture. Term 6. Dividend yield. What if your stocks sent you cash every quarter just for owning them? That's what dividend yield shows. What it means: dividend yield tells you how much cash you get every year as a percentage of the stock price. It's pure income without selling any shares. Many retirees love high dividend stocks for steady cash flow. Formula: dividend yield equals annual dividend per share divided by stock price times 100. Example: Coca-Cola pays about $1.84 in dividends per share every year. At $60 stock price, that's roughly 3% yield. Invest $10,000, you get $300 cash every year automatically. Apple has a low yield, around 0.5%, because they prefer buying back shares instead of paying big dividends. Red flag: if a yield is 10% or higher, be careful. It often means the stock price has fallen a lot. Always find out why before buying. Term 7. Debt-to-equity ratio. Would you trust a person who borrowed $9 for every $1 they actually own? Probably not. That's what the debt-to-equity ratio shows about a company. What it means: debt-to-equity ratio tells you how much of the company is funded by debt compared to its own money, equity. 1.0 means equal debt and equity. Above 2.0 is usually risky. Different industries have normal levels, like airlines and utilities carry more debt. Formula: debt-to-equity ratio equals total liabilities divided by shareholders' equity. Example: in 2008, Lehman Brothers had a debt-to-equity ratio of over 30. They owed $30 for every $1 they owned. When things went bad, they went bankrupt. Microsoft has a very low debt-to-equity ratio because it makes tons of cash from its business. Checking debt-to-equity can save you from big losses. Final insight: no single ratio tells the full story. Smart investors look at PE, ROE, and debt-to-equity together. So, now you know the 7 key terms professionals use to analyze any stock: PE, EPS, P by B, ROE, CAGR, dividend yield, and debt-to-equity. These give you X-ray vision into any company. But here's what most beginners still don't know even after learning these. How do you actually buy or sell a stock? What does going long mean? What is short selling? What is a stop loss, and how does it protect your money? That's exactly what video 4 is all about. Trading terms, the practical stuff you need before your first real trade. If you don't want to lose money on your first investment, watch video 4 right now. The link is below. I'll see you in the next one. Take care.